Welcome to the Deep Dive. Today we're jumping into the Q3 2025 earnings call for CLTD, ticker SE. This is the big one, the Southeast Asian titan covering everything from gaming and e-commerce to fintech.
And this quarter gave us what we'd call a classic mixed print. I mean, you had this really robust top-line momentum, but then that was set right against a frankly disappointing margin performance.
A mixed print is putting it mildly. The market's reaction was pretty brutal.
It was harsh, yeah. It suggests investors are really, prioritizing that margin trajectory over just how fast the company is reinvesting for growth.
Okay, so that's our mission today. Let's unpack that divergence. We need to look past the headline numbers and figure out where management is actually putting its capital, and more importantly, what's funding all this expansion.
Right. We need to look at the strength of Garena and then the really aggressive but targeted expansion of Shopee and SeaMoney.
Let's start with the financials then, the numbers that really dictated the market's reaction.
Okay, so let's ground ourselves there. The story really begins with a strong revenue beat. Group revenue hit $6 billion.
$6 billion.
Yeah, $6 billion, which, easily surpassed the consensus estimate of about $5.97 billion. That's 38.3% growth year over year.
38% is a huge number at that scale. But of course, that's not where the story ended. The enthusiasm was, let's say, immediately tempered by the profit picture.
That's exactly right. The clear miss was on profitability. GAAP EPS came in at 59 cents, falling way short of the consensus estimate of, around $1.03.
So a 44-cent miss, that is a massive gap.
It is, and that gap is the pain point. That's where the market just zeroed in. Operationally, though, things were actually quite healthy. Gross profit was up almost 40%, net income up 145%.
So the core business is still churning.
It's very healthy. Adjusted EBITDA still landed at $874 million, giving them a pretty decent margin of, about 14.6%, but the market just looked right past all that.
And focused solely on the higher than expected spending.
Solely on that. And it defined the day. You saw the stock, it closed down, 8.2%? On volume, that was 4 times the average.
The message seems crystal clear then. The street supports growth, but not at any cost. They want to see that margin story hold up.
It's a trust thing, right? Can management actually control spending while still growing?
That is the critical question. And if we look at the e-commerce segment, Shopee, management's whole theme was this balancing act between growth and monetization. And to their credit, they delivered record volumes.
What did the GMV look like?
GMV gross merchandise value hit $32.2 billion. That's up over 28% year over year, driven by 3.6 billion orders.
Okay, so they're selling more stuff, but are they making more money on each sale? Because that's the key. They are. And that's where it gets interesting. Their core marketplace revenue, so that's your transaction fees and your advertising it increased a stunning 53%.
53. So what was the biggest driver there?
Advertising. Ad revenue alone grew over 70%. And this isn't just organic, it's structural. They noted a 25% increase in the number of sellers actively using their ad products.
Which proves the platform is becoming essential. Sellers are willing to pay because they know it works, it converts.
It converts. It's not just a listing service anymore, it's a core marketing channel.
Okay, so monetization is working. But what about the massive spending that spooked everyone? I assume a lot of that is going into logistics and fulfillment.
A huge chunk of it. They're building that infrastructure moat, and they gave some really good specific examples to show that this investment is actually smart.
Like what?
Well, they're deploying these highly customized local solutions. I mean, that's the only way to win in a fragmented region like Southeast Asia. Take Jakarta, for example. The consumer there wants instant gratification.
Same-day delivery.
Or even instant delivery. By rolling those options out, orders using those faster services shot up 35% year over year. That is pure market share gained through speed.
And speed costs money. But they're also attacking the cost side in other areas, right?
Yeah, exactly. You look at the rural regions outside of Java, the priority there isn't speed, it's affordability. So Shopee developed these lower cost solutions, cutting the cost per order by 20%.
And what did that do to volume?
It boosted orders by over 45%. So it's this perfect example of tailored efficiency. You spend where it matters, like on speed in Jakarta, and you save where you can, like on cost in rural areas.
That's how you build a real local moat against, a global competitor who might have a one-size-fits-all network. What about the Taiwan example? That was fascinating.
Right. In Taiwan, they leaned into a totally different consumer behavior,
Yeah.
self-pickup. They expanded their automated locker network to over 2,500 locations.
And what's wild is that this network now handles, what, over 70% of all deliveries in Taiwan?
70%. And it runs at a 30% lower cost per order than traditional pickup. So this investment isn't just about growth, it's about aggressively lowering your cost to serve while making the customer happier. It's brilliant.
And they're now moving upstream, focusing more on fulfillment.
Yeah, exactly. So they're using, intelligent demand forecasting to pre-ship popular products closer to where people live, and they're doing it in a capital light way, mostly leasing warehouses instead of buying them.
Smart. Now let's talk about user engagement, the Shopee VIP program.
Right. That program is really starting to scale. It's now over 3.5 million members across key markets, which is up 75% in just one quarter.
And these members are valuable.
Oh, incredibly. They buy 3 times more often and spend 5 times more than non-subscribers. But here's the most powerful data point they shared.
What was that?
In Indonesia, members spend around 40% more after they subscribe. So the program isn't just attracting their best customers, it's actively making customers spend more. It's changing behavior.
Which explains their confidence. They updated the full-year GMV growth guidance for Shopee to greater than 25%.
Right.
So that user data, that stickiness,
Right.
how does that translate into the confidence we're seeing in their lending arm, SeaMoney?
It's the perfect transition. Because SeaMoney is that quiet second engine. And that credit flywheel works precisely because they know their users' spending and payment history inside and out from Shopee and Garena.
Let's hit the numbers there.
Revenue grew a massive 61% year over year to nearly $1 billion. Loans outstanding hit $7.9 billion. That's a 70% increase.
Okay, 70% growth in lending. The first thing any investor thinks is risk. What's happening to credit quality?
Absolutely. But this is probably the most remarkable part of the whole quarter. Their risk profile is rock solid. The 90-plus day non-performing loan ratio, the NPL, it remains stable at just 1.1%.
Wow. To grow your loan book by 70% and keep your NPLs locked at 1.1%.
It suggests their credit modeling, powered by all of that first-party data, is probably the most valuable asset they own. It's a huge competitive advantage.
And they're so confident they shifted to an all-can-apply approach.
Yes. They're using their huge existing user base to find these first-time borrowers. They added over 5 million of them this quarter alone. It shows they can underwrite customers that a traditional bank would just, completely miss.
And the really big future growth story here seems to be taking SpayLater off the Shopee platform.
That's the unlock. This off-Shopee SpayLater business, it grew over 300% year over year. Now, we should be clear, it's still less than 10% of total loans.
But that just shows the upside.
That's the massive upside potential. They are just starting to tap into offline and third-party merchant spending, which is a market that's orders of magnitude larger than just their own e-commerce platform.
So the credit flywheel is spinning, and it's spinning responsibly. Now let's talk about the big surprise, the segment that really provided the unexpected good news. Garena. Digital entertainment. It delivered its best quarter since 2021. And what that really means is it's providing unexpected internal funding for all this expansion we've been talking about.
How much upside are we talking about here?
Significant. Bookings grew 51.1% year over year to $840 million. I mean, that is a massive turnaround from where they were, and it was almost entirely driven by collaborations.
Specifically, the tie-ins with Squid Game and the Naruto Shippuden Chapter 2 campaign.
Exactly. The Squid Game challenge, for instance, was played over 300 million times. That's the kind of engagement that translates directly into dollars.
And they talked about their strategy here about being authentic to the IP.
Yes, and I find this fascinating. Their creative teams are required to be super fans of whatever IP they partner with. For Naruto, they actually continued the storyline from the anime. They added specific character attacks, even redesigned the map to be a destroyed ninja village.
Details only a real fan would appreciate. And it paid off. Chapter 2 beat Chapter 1 on every metric: engagement, revenue, satisfaction scores. It just proves that authenticity works. Garena is now on track for greater than 30% bookings growth for the full year.
So if we step back, we have massive growth, monetization is working, a clean and scaling fintech arm, and a resurgent gaming division. And yet, the stock got punished.
It's a huge divergence. Management is talking about durable structural advantages, and the market is just laser focused on that EPS miss and the spending.
Which brings us back to the market reaction. It was all about the pace of reinvestment, specifically sales and marketing, right? To fight off competitors like TikTok Shop.
Exactly. You have TikTok Shop and Lazada spending aggressively in Southeast Asia and Latin America. And investors are really sensitive to Sea's margins because, unlike the segments, there was no consolidated revenue or EPS guide for the full year.
And the market just hates uncertainty.
It hates uncertainty about margin recovery more than anything else.
But management tried to reassure everyone that this spending is different from 2 years ago.
They did. They're arguing that this time, the investments in logistics, fulfillment, the VIP programs, they're all designed to structurally lower the cost to serve.
And you can see the proof, right? The 2-day delivery improvement in Brazil, the 30% lower cost in Taiwan.
And the near immediate returns, like the VIP members spending 40% more after joining. This isn't just burning cash for growth, it's an investment in efficiency.
We should also touch on AI. Management call it transformative, saying it could make them $1 trillion company. What's their actual approach here?
It's very pragmatic. What's fascinating is that their strategy is application-focused, not CapEx heavy. They are not building foundational models or spending billions on data centers.
They're a user, not a builder.
Precisely. They're applying AI to immediately improve ad conversions, to optimize product discovery, and to slash customer service costs. The majority of their customer service is already handled by an AI chatbot. It's all about immediate, measurable ROI.
Okay, that makes sense. It's time now for our outrageous but plausible trade idea, reflecting on this big divergence between the fundamentals and the stock reaction.
Right. So the market basically threw the baby out with the bathwater. It punished the stock for a short-term EPS miss, while I think overlooking two huge structural strengths, the resurgent Garena funding machine and the safe, rapid scale-up of SeaMoney.
So you're seeing a volatility opportunity.
I am, precisely. You saw the elevated options activity and then that quick IV crush right after the print. So the trade pitch is this. Sell the near-term volatility to fund a long-term position in the SeaMoney credit flywheel.
Okay, walk me through the execution of that.
You'd sell short-dated, out-of-the-money puts. You're leveraging those panic-driven premiums from the sell-off to generate income. Then you take that income and you use it to buy long-term calls that are focused specifically on the continued expansion of the off-Shopee Pay-Later business.
And why focus so tightly on that one specific segment?
Because that is the unpriced future growth driver. I mean, think about it. SeaMoney is growing revenue at 61%, its loan book is almost $8 billion, and the NPL is locked at 1.1%. The off-platform business growing at 300% proves they can scale credit responsibly outside their own little garden.
So the trade basically capitalizes on the market's short-term obsession with S&M costs while positioning for the long-term compounding story.
That's the idea. You're betting on the financial services ecosystem.
All right, so to summarize, Q3 showed really strong underlying growth pretty much across the board. Record Shopee volumes, a resurgent Garena, and that responsible rapid credit scaling at SeaMoney.
And the narrative is really still intact. The company is using its profitable segments, Garena and now SeaMoney, to fund that aggressive but strategic expansion in e-commerce. Investors are just clearly watching the pace of that spending with a very critical eye on margins.
What's the one thing that stands out to you as the biggest long-term advantage here?
It's the ownership of the credit data. If you dominate transactions with Shopee and you dominate credit scoring with SeaMoney in a region where banking is still, not everywhere, that first-party data creates this incredibly powerful barrier to entry for any new competitor. It doesn't matter how much cash they bring.
A very powerful point. And a reminder to everyone listening, this discussion is solely for informational purposes and is absolutely not financial advice.
Thanks for joining us for this deep dive.
And if there's a specific earnings call you want us to unpack next time, be sure to let us know.